County court judgments. I'm not going to embarrass anyone by asking who's got county court judgments. County court judgments will appear on your credit file. Again, depending on the kind of county court judgment, depending on how recent it was, how much it was for, can have a determination. If it was like 80 quid from a catalogue company that you were in dispute with anyway, it may not be the end of the world, but they will all see that information. And a lot of the more mainstream lenders will choose to decline anybody who applies them for finance if they show county court judgments, okay? After 6 years, county court judgments will disappear from the credit file, and the credit file will also show if the county court judgment has been settled. So again, if it's only for a couple of hundred quid and you've settled it, then a lot of lenders would ignore it anyway. But just be aware that if any of you do get any county court judgments, they will show on your credit file and they will potentially harm your ability to get finance. IVAs. Sounds like a savings plan or something, doesn't it? You know, ISAs, IVAs. No, what's it stand for? Individual voluntary arrangements. It's a milder form of bankruptcy. It's where the amount of credit you owe becomes unsustainable against the income that you receive. You then have to make an arrangement with your creditors to pay them back a smaller amount of money. In return, they will write a certain amount of money off, but things like that will show on your credit file. Obviously, any IVAs or bankruptcy is going to have a massive impact on you getting a mortgage. Bear that in mind. Credit accounts. So any credit card, any loan that you take out, what it will show is the date that you took it out. It will show potentially the credit limit, the term that loan was set up for, the balance outstanding, the amount of the monthly payment, and your payment history. Now, it is not a 100% foolproof system. Not every company registers their information with the agency, so it's not foolproof. And if you see your own credit report, you may realise that actually there's one or two of your credit cards or a loan or a hire purchase that isn't showing on that credit file. But by and large, probably 80% of any finance that you've got will show on the search. If you miss a payment, it will show that. If you go 2 months down, if you're in arrangement with that company paying a lower amount than you should be, it will all show on your credit file. It will affect your score. It will affect whether a lender would give you the money, and if so, at which rate they would give that to you, okay? Repossessions. If you've had a property repossessed, there is a register that shows on there. It never leaves that register, so every lender you go to will have access to that information, okay? Previous searches. Every time you apply for credit anywhere, it leaves a footprint on your credit file to show that an application has been made. So if you have a lot of applications within a short amount of time, it may affect your credit score, may affect the company's decision on whether to lend you money or not, particularly if a lot of the credit is recent, okay? So just bear that in mind. If you're just, interested in rates, but don't want to take it any further than that, don't ever make a full application that you don't intend in going ahead with, okay? Gone Away Information Network, GAIN, is a system where people who've vacated properties leaving debts and then moved on, then that information is held on what they left and walked away from. So companies have got access to that. And the fact somebody's moved away from a property doesn't mean they've got away with everything they owed at that property. CIFUS, Credit Industry Fraud Avoidance System. Anybody in this room been a victim of identity theft? Yeah. I mean, very, very big thing, very, very prevalent in the media at the moment. People will go steal somebody else's identity, try and take out credit and stuff in their name. There's two kinds of CIFUS alerts, really. The one is anybody who has been trying to make any kind of fraudulent application or has been the victim of identity theft. It will flag up an alert, so the company that you're applying for will need to check that you are actually the person that they think you are and that you are legitimate. You can also put a voluntary CIFUS alert on your credit file. if you were weary at all about anybody around you trying to steal your identity or just for your own peace of mind. So any credit that you're applied for, they will carry out additional checks before they give you that credit. Okay, lovely. Now, the credit file, as I've already mentioned, will dictate the kind of mortgage you get. If you tick all their boxes, you know, then you could get a very good rate. It's not an exact science. Different companies use different ways to determine it. You know, some companies will just say if they earn that amount and the loan to value is below a certain amount, great. Also, the rental income will need to cover a certain percentage of the mortgage. Again, the general rule of thumb is that your rental income from the property should be 130% of whatever the mortgage payment is on an interest-only basis. So your mortgage payment is £500 a month. That company would be looking for £650 rental income to be achieved on your property. Some companies do 120%. I haven't heard of any yet going over 130, some at 125. Some of the higher risk lenders who will charge you a higher rate may even go as low as 100%. They may say, as long as your rental covers the mortgage, we don't care. But generally, if you work to a rule of thumb of about 130%. Okay. Again, we've already been through the attitude to risk. The main two factors that you've got with a mortgage, fixed rate or variable. Someone give me an example, benefit of a fixed rate?
You know what your
exactly. You know exactly what your payments are going to be. So somebody says, right, we'll fix your £100,000 mortgage at 6%. 6% of 100,000, £6,500 a month. You know, every single month for whatever period the mortgage is fixed for, whatever happens to interest rates, if they rocket, you don't care because yours is fixed. You only ever pay that £500. The flip side of that is if interest rates go through the floor, I mean, they went down in the last couple of weeks by 0.5%, people with a fixed rate won't benefit from those reductions. But it's absolutely that. Fixed rate, peace of mind, know exactly what you're getting. Variable rate, you take a chance. You're happy that whatever rate you pay will move upwards or downwards according to the market trend. Some rates track the Bank of England rate, some track their own standard variable rate with a discount. Sorry, go on.
James, is there a situation where you would not take an interest-only loan?
Again, I'm not going to give any kind of financial advice today.
No, not financial advice, just personal opinion.
Personal opinion, I mean, if capital and interest, yeah? You're paying back the capital balance over the period of the loan. So you take out a mortgage today over 20 years on a capital and interest basis. Great. You make your payments for 20 years at the amount they say. At the end of that 20-year period, the loan is paid off in full. You owe them nothing. The property is yours, yeah? How many people in this room have kept the same mortgage company for 20 years on the same rate and the same deal? Anyone? I don't know.
Yeah, but like if you were to look at an investment and you stacked up the numbers, you'd obviously have to take in consideration principal's interest or just interest, purely interest.
Absolutely.
Within the numbers. And so why would I go principal and interest?
Okay, you would go capital and interest. The only circumstances I can really say in a buy-to-let arena that you would go capital and interest is because you want that property paid off at the end of the term and it's a plan that you've got yourself. The advantage of going interest only is you give yourself a lower monthly commitment. Now, in this game buy-to-let, it's all about cash flow. It's all about having the right money at the right time. What you're doing by going interest only, you're effectively giving yourself the lowest possible monthly commitment to give yourself the best possible cash flow. Now, depending on the company you're with, gives you more options. You could have a situation where your interest only payment is £500. Your capital and interest payment over a 20-year term is £750, yeah?